Please confirm you can hear me clearly.
Good evening, sir.
And you can see my screen.
Good evening, sir. I can see your screen from my end.
Good evening, sir. I can see too.
All right. Tonight we are rounding up with variance analysis. Our approach tonight, we won't do much of theory. A brief explanation, we now go to the formula. Variance and budget, they are very related. For those in class last week, the question we saw on flexible budget. That question took us to variance reporting. Please, can you mute? When you get to the class, your speaker is on, you are completing the class.
Wait,
Please, can you mute?
how many public holidays, breaks do we have this third term? Wait, how many? It's not going, I don't know. 7.
Oh.
1, 2, 3, 4, 5. Yeah.
This person is disturbing our class. Naya, please, can you mute? And that is the challenge. Somebody get to the class, you are doing your own private business. Now, variance and budget, they are very related. If you remember budget, we said budget. What we plan to achieve in monetary terms. If you remember your budget, we said budget. Budget can be defined as the monetary value of the company's plan. The monetary value of what the company plans to achieve. At the end of the financial year, you now have your actual results. At the commencement of the financial year, you draw your budget. What I plan to achieve in December. At the start of the financial year, you prepare a budget showing the monetary value of what you plan to achieve at the end of the year. At the end of the year, you now have your actual results. You now compare your actual results with your budgeted plan. Variance is when actual result is different from budgeted plan. Your variance is a situation where your actual profit is different from your budgeted profit. Variance, a situation where your actual cost is different from your budgeted cost. Variance, a situation where your actual revenue is different from your budgeted revenue. Variance is any deviation from expected level of performance. Variance, we can define it as any deviation from acceptable level of performance. Your budget is what you try to achieve. Your set objective. You now compare your actual results with your budgeted plan. If actual results is different from budgeted plan, then we say there is variance. What is variance analysis? Variance analysis is the process of investigating the cause or causes of variance. When you say variance analysis, when we compare actual results with budgeted plan, our actual results is different from budgeted plan. Assuming your budgeted profit, the profit you plan to achieve is 10 million. Assuming your budgeted profit at the end of the financial profit happens to be 8 million. Actual profit is less than, that means there's 2 million naira variance. There's heavy rain in my area here. We are hoping that the network will allow us to run the class. That means you have a 2 million naira variance. We now want to ask, how come we have 2 million naira negative variance? The process of investigating the cause or the causes of variance is what we call variance analysis. So you can have cost variance. You can have sales variance. Where your actual cost is different from your budgeted cost. That means you have cost variance, where the actual cost is different from your budgeted cost. That means there is cost variance. Now look at your screen. We want to discuss cost variance. Number one, direct material cost variance. Your direct material cost variance, where actual material cost is different from budgeted material cost. Direct material cost variance, where actual material cost, water, get me water, sorry please. Where actual material cost is different from budgeted material cost, or where your actual material cost is different from standard material cost. Direct material cost can be subdivided into two. Roma figure 1. direct material price variance. What is direct material price variance? Where actual material price is different from standard material price. Direct material price variance, where actual material price is different from budgeted material price. If you are to calculate direct material price, please look at the formula on your screen. Standard material price minus actual material price, close your brackets, put it in brackets, then multiply by actual quantity of material purchased. Please, you can write it down if you want. You can copy it down if you want. That is how to calculate direct material price. Roma figure 2. Direct material usage variance. We said direct material cost variance can be subdivided into two: direct material price variance and direct material usage variance. Now look at formula for this. Your direct material usage variance is calculated as, okay, let's define it first. Direct material usage variance, where actual material usage is different from standard material usage. Where actual material used is different from standard material. That will give rise to direct material usage. Now, if you have to calculate this, open a bracket, standard material for actual production minus actual material used. Standard material for actual production. Let me explain that. We are going to calculate standard material required for actual production minus actual material used for actual production. You now get your difference. Multiply by standard material price. Please, you can document this in your book, so that if you are calculating today, you can be looking at the formula. Next. Direct labor cost variance, where actual labor cost is different from budgeted labor cost. Direct labor cost variance. This occurs where actual labor cost is different from budgeted labor cost. We can divide this We can divide direct labor cost variance into two. Direct one. Direct labor rate variance. Your direct labor rate variance, where actual labor rate is different from standard labor rate. This is calculated as standard labor rate per hour minus actual labor rate per hour multiplied by actual labor hours. Standard labor rate per hour minus actual labor rate per hour multiplied by actual labor hours. Roman figure 2. Direct labor efficiency variance. Your direct labor efficiency variance occurs where actual labor hour used is different from budgeted labor hours. This is used to measure efficiency 1 hour to produce a product. That is the standard. You now use 2 hours. You now compare standard hour 1, actual hour 2. That means the employee is not efficient. To calculate direct labor efficiency variance, this is calculated as standard labor hours for actual production. Victoria, please mute. Standard labor hours for actual production minus actual labor hours used. You get the difference. Multiply by standard labor rates per hour. That will give you direct labor efficiency variance. So we have discussed direct material cost variance. We have discussed direct labor cost variance. We move to number 3. So please, I will expect you, when you get back, copy this formula somewhere. This formula will not change. Now try to use it to solve questions. The formula will not change, regardless of the question. Number 3, variable production overhead variance. Your actual variable different from your budgeted variable overhead. Variable production overhead. This occurs. Variable production overhead variance. Variable production overhead variance occurs where is different from standard variable overhead cost. This can be subdivided into two. We can subdivide this into two. Variable production overhead expenditure variance. That is one. Variable production overhead expenditure variance. And we have variable production overhead efficiency variance. Your variable production overhead expenditure variance is the difference between absorbed variable overhead and actual variable overhead incurred. Where actual variable overhead is different from absorbed variable overhead. This is calculated as, look at the formula, actual labor hours multiplied by overhead absorption rate. Please note, VOAR, variable overhead absorption rate. Then put in brackets minus actual variable overhead incurred. Mike, any question? If not, please mute. Roman figure 2. Variable production overhead efficiency variance. This is used to measure efficiency. And it's calculated as. Ahmed, please, can you mute your speaker? Calculated as standard labor hours for actual production. Please monitor that thing very well. Standard labor hours for actual production. You are going to get the differences in hours multiplied by variable overhead absorption rate per hour. Then lastly, we have fixed production overhead variance. Where your actual fixed overhead is different from your standard fixed overhead. We can also divide this into two. The fixed production overhead variance can be subdivided into two. Roman figure 1, fixed production overhead expenditure variance. This is the difference between projected fixed overhead and actual fixed overhead. This is the difference between the budgeted fixed overhead and the actual fixed overhead. It's calculated as budgeted fixed overhead minus actual fixed overhead. Roman figure 2. Fixed production overhead, volume variance. Fixed production overhead, volume variance. This occurs where actual production volume is more or less than the budgeted production volume. This occurs where your actual production volume is more or less than the budgeted production volume. It's calculated as actual production volume minus budgeted production volume. You get the difference, multiplied by fixed overhead absorption rate per unit, please. Please, there's what we call cost per hour and cost per unit. You are going to watch it. If the variables involve hours, then we are going to multiply by cost per hour. If the variables involve units, then you are going to multiply by cost per unit. So you got to be very careful. A lot of students, they don't know how to differentiate between cost per hour and cost per unit. You can also have cost per liter and cost per unit. Material cost per kg is different from material cost per unit. You got to try to understand it. We are done with all the cost variances. We are done with all the cost variances. We now look at sales variance. Recall our explanation. We said variance, situation where budget is different from actual. You can have cost variance. What are the components of cost? When we say cost of a product, the cost of a product will include material cost, labor cost, variable cost, fees cost. If I say, what is the cost of a bottle of Coke? If I ask you, what is the cost to produce one bottle of Coke? You are going to calculate the material cost for the bottle of Coke, labor cost for the bottle of Coke, variable overhead cost for that Coke, fixed overhead cost for that Coke. Now, please note, you are going to be talking of fixed production overhead cost. if the company uses absorption costing system, you are going to be calculating fixed production overhead costs. If the company in question uses absorption costing system, but if the company uses marginal costing system, that means fixed cost is not part of cost of production under marginal costing. In that case, you are not going to calculate fixed production overhead cost variances, because the company uses marginal costing system. All right. Let's look at sales variances. When we say sales variances, where your actual sales revenue is different from your budgeted sales revenue. Management will be interested to know. Our budgeted revenue is 10 million. We now achieve 9.5 million. Management, we want you to explain, why is it that we cannot achieve our budgeted sales revenue? Sales variance can be divided into two: sales price variance and sales volume variance. We can divide this into two: sales price variance and sales volume variance. Sorry for the break. You can imagine the rate at which lecturer will take water. It's raining heavily here. If I don't put shout at the top of my voice, you might not even hear me. Your sales price variance. When we say sales price variance, that means actual selling price is different from standard selling price. Without cramming itself, if you say sales price variance, that means actual selling price is not the same with the standard selling price. Your sales price variance is calculated as actual selling price minus standard selling price, then multiplied by actual quantity sold. Multiplied by actual quantity sold. Sales volume variance. Look at the word, sales volume. That means volume variance, volume difference. It means that our budgeted quantity is different from our actual quantity sold. Your sales volume variance is calculated as, open a bracket, actual quantity sold minus budgeted quantity multiplied by standard profit per unit. Your standard profit is calculated as standard selling price minus standard absorption cost per unit. Let me try to write this again. Standard selling price minus standard absorption cost. You are going to use standard profits if the company uses absorption costing system. You are going to use standard profits if the company uses absorption costing system. But if the company uses marginal costing system, then you are going to multiply with standard contribution. Your standard contribution is standard selling price minus standard marginal cost. We are done with the explanation. We are done with the explanation. This provides you with the foundation knowledge of variance. Any question? Any clarification? Please refer to your study pack where you have variance. I think page 96. Question number 1. Please, can we refer to our study pack? Goodland Limited. We got no luxury of time, please. Check page 100. Question 1. It's inviting me. I'm not 100% sure of the page. Let me even check here. where we have variance. Yeah. Page 1 was?
Illustration 1.
Page 1 was?
That's all.
Page
106, illustration 1. 106,
Page 106.
106.
Thank you. Page 106, question 1. Thank you, Luatusi. So we move with the question. I'm just trying to expand this. Let's go on with this. Okay, because I expanded it. Maybe better. Yeah, thanks. All right. Goodland Limited produces and sells a single product. The company adopts a standard absorption costing system. Can you see it? This company adopts a standard absorption costing system and absorb overhead on the basis of direct labor hours. Presented below are the standard cost details and selling price for a single unit of the product. The selling price is 6,000. Please correct it in your, not 600 naira. Price is 6,000. Direct material, 30 liter at 90 naira is equal to 2,700. Let's explain this. Examiner says direct. To produce 1 unit standard, you require 30 liters of raw material. Price per liter is 90 naira. If you multiply 30 liters by 90 naira, that will give you 2,700 naira. That is material cost per unit. To produce 1 unit, I'm going to use 30 liters of raw material. The price per liter is 90 naira. If I multiply 30 liters by 90 naira, I will get 2,700. That is direct material cost per unit. So please, learn how to differentiate between cost per liter, material cost per liter, and material cost per unit. Next, direct labor. 10 hours at 120 naira per hour. Let's explain this. To produce 1 unit standard, you require 10 hours of labor. Laborers are paid 120 naira per hour. If you multiply 10 hours by rate per hour. 10 hours multiplied by 120. That will give you 1,200. That 1,200 is direct labor cost per unit. That 120 naira is direct labor cost per hour. So guys, learn how to differentiate between labor cost per hour and labor cost per unit. Variable production overhead, 10 hours at 60 naira per hour. What that means is that to produce one, we require 10 hours of labor. Variable overhead is absorbed at the rate of 60 naira per hour. That 60 naira per hour, that is the variable overhead absorption rate. The rate at which variable overhead is absorbed per labor hour. Examiner says overhead, we absorb overhead on the basis of direct labor hours. Fixed production overhead, you have the hours. The 30 naira is the fixed overhead absorption rate per hour. The 300 naira is the fixed overhead cost per unit. Every information here is your standard. Standard selling price, standard material cost, standard labor cost, standard variable overhead cost, standard fixed overhead cost. If you sum these four together, 2,700 plus 1,2 plus 600 plus 300, that gave you 4,800. That is the standard cost per unit. For me to produce a unit, I'm going to use raw material. I'm going to use labor. I'm going to use variable overhead. I'm going to use fixed overhead. The standard cost per unit is 4,800. You now have your gross profit per unit. That is the standard cost, standard profit per unit. Standard selling price minus standard absorption cost per unit. I'm trying to explain this so that when we get to computation, you can relate with it. It has been estimated that the production and sales for the month will be 2,000 units. Look at it. The company plan is to produce and sell 2,000 units. That is our budget. Our budget is that we are going to produce and sell 2,000 units. And we are doing in a month, our budget for that month. Our budget for 1 month is that we should produce 2,000 units and sell 2,000 units. However, the estimated production for the month has been used as the basis for determining the fixed overhead absorption rate. Actual results for the month. Actual production, 2,800. Actual sales, 2,400. Actual selling price, 6,120. Actual direct material cost is given. Actual direct labor. Actual variable overhead. Actual fixed overhead. Requirements 1 for 20 marks. Prepare a statement that reconciles the budgeted gross profit with the actual gross profit for the month, with a detailed computation of all the variances involved. 20 marks. Examiner wants us to reconcile budgeted gross profits with actual gross profits using variance. Now, for you to reconcile two parties, you are asked to reconcile two parties. It makes sense if you know the two parties. I want to reconcile budgeted gross profits with actual gross profits. Now ask yourself, what is the budgeted gross profit? What is the actual gross profit? For me to reconcile two parties, I must know them. You know, without the examiner telling you, you also must reason it out. That means my working will start from my first working one. Please get your calculator closer to you. Let me even get mine. Because at times you wait for students. For all you care, some might log on and he just sleeping. Working one. Calculation of budgeted gross profit. This is equal to budgeted sales units multiplied by standard profit. If you go back to the question, the company has estimated that the production and sales for the month 2,000 units. Gross profit per unit, standard, 1,200. Our budgeted sales units, 2,000 units. Standard profit per unit, 1,200. This equal to 2.4 million. Or we can put it here, 2,400,000. You have gotten the budgeted profit. The company wants to achieve 2.4 million at the end of the month. Working two. Calculation of actual gross profit 2 naira sign. Start with your actual. So there's no point putting actual. Your sales value. Sales value. Quantity sold, actual. Look at the actual table. Sales, actual result. 2,400 units. Actual selling price, 6,200. Please multiply. Actual sales value, 2,400. Multiply by 6,120. Get your actual sales. Get your actual sales revenue. Oh yeah.
14,000. 14,688,000. 14,688,000. Sorry.
Thank you. 14,688,000. Let's assume 30 up for convenience. You have gotten your actual revenue. Now come to your cost. Cost. Direct material cost. If you look at the question, examiner say 88,000 liters at a price of how much per liter? $88,000 liters at 120 naira per liter. Get your material cost. 88,000 liters multiplied by 120. That gives us
10,000.
10,000,560.
10 million, sorry.
Move to direct labor. Examiner say 21,000 labor hours at a rate of 150. $3,150,000. Now pick your variable production overhead. Actual, how much?
660,000.
Pick your fixed production overhead. Actual, how much?
360,000.
Now sum up your costs. Total. $14,730,000. That is the total production cost. Now, do we have closing stock? Do we have closing stock less closing stock? Check the question. Examiner will not tell you, you are the one that will check. Actual production, 2,800. Actual sales, 2,400. That means you have closing stock of 400 units. Is that clear, please?
Yes, sir.
That means there's a closing stock of unsold stock. Now, please note, your closing stock will be valued as standard cost per unit. The standard cost per unit is 4,800. Please note, if you are to value your closing stock, you don't put profit to your stock unsold. You only use the standard cost. Come here. Our unsold stock, we have 400 units to be valued at 4,800 naira per unit. Please multiply. That will give you 1,920,000.
Yes.
1,920. Your production cost minus your closing stock. That will give you cost of goods sold. 14,730,000 minus 192,000. You have 12,810.
810.
Now you can now get your profit, actual profit. Your sales minus cost of goods sold. $14,688 minus this. That give me 1,878. 1,878. This is the actual gross profit. You look at working one. The budgeted gross profit is 2.4 million. The company wants to achieve 2.4 million profit budget. At the end of the month, the company achieved 1,878,000. Management now asks you, reconcile this profit for us. Explain to us why our projected profit is not equal to our actual profit. And you are going to explain this using variance analysis. Variance analysis is used to investigate the cost or the causes of differences between the budgeted profit and the actual profit. We can now move to that variance analysis. Please The formula we have explained now, that is what we are going to use now. We can leave that space. Just come here. Statement. Of reconciliation. Budgeted profits with actual profit. We have our Naira sign. Again, let's assume 20 up for convenience. Start with your budgeted profit. 2,400,000. Now you now be picking it. Go and check your sales variance. Sales variance 1. You have sales price variance. 2. Sales volume variance. If you have to calculate sales price variance, now let's go to the working down. I'll leave for this page. I'll come here working. My sales price variance. Because of time, actual selling price minus standard selling price. Actual selling price minus standard selling price multiplied by actual quantity sold. Our actual selling price, check the question, 6,120. Standard selling price, 6,000 naira. Actual quantity sold, 2,400 units. Please get your sales price variance. You have 288,000. 288,000 favorable. F is positive. If you have positive variance, that means favorable. Your plan is to sell for 6,000 naira per unit. On getting to the market, you sold for 6,120. That is favorable. You come to sales volume variance. The formula actual quantity sold minus budgeted quantity multiplied by standard profit. Actual quantity sold 2,400 units. Budgeted quantity 2,000 units. Standard profit per unit 1,200. Please compose. You have 480,000
Favorable.
So please open the question and follow. For me to be going to check up and down is consuming time. You can return to your page. You have here 288 favorable, 480 favorable. We now come to cost variances. All the costs you are giving direct material cost, you are giving direct labor cost, you are giving variable overhead cost, you are giving fixed overhead cost. You are not going to investigate. Now look at this sales variance now. That our sales, we are doing well. Our plan is to sell for 6,000 naira. On getting to the market, we are able to, we sold for 6,120. Management will clap for the sales team. Our plan is to sell 2,000 units. Actual quantity sold 2,400. Again, management will applaud the sales director. You are doing well. Now come to the cost. Direct material cost. We have direct material cost variance. Under it, you have direct material price, and you have two direct material usage. Go back to your working sheet. Working two. Let's go on. Oh. And we have been enjoying the class, so almost 1.5 hours, no interruption. So actual quantity material purchased. Now, the material purchase is in liter. The material purchase is in liter. The price you are going to pick is in liter. Standard material price, go and check, per liter, 90 naira. Actual material price per liter, 120 naira. Actual quantity of material purchased in liter, 88,000 liters. This will give you direct material price variance. This will give you direct material price variance.
The answer is 2,640,000 adverse.
Thank you. Our plan is to buy raw material for 90 naira per liter. On getting to the market, we bought material for 120 naira per liter. This will give us 2,640,000 adverse. Management will ask question, why? How come you are paying extra 30 naira for material? We now go to direct material usage variance. Remember the formula. Standard material for actual production minus actual material for actual production multiplied by standard material price. You have to do small calculation here. Standard material actual production. You must do small calculation. Actual production is 2,800 units. Actual production is 2,800 units. Management said to produce one, you are supposed to use 30 liters of material. That means if I produce 2,800, how many raw material am I supposed to use? I produce 2,800. Management said 30 liters per unit. That means I should have used 84,000 liters. Actual material use, 88,000 liters. That means there's a problem. Since I produce 2,800 units, and management said to produce 1 unit standard, you are supposed to use 30 liters. That means I should have used, if I follow standard, I should have used 84,000 liters. Actual material used, 88,000 liters. Multiplied by the standard price per liter. Now this is in liter. This material is in liter. Then the material price you are going to pick must be in liter. 90 naira per liter. You have 360,000 adverts. Management with someone, production manager, as well as the purchasing manager. How come your staff are using 4,000 liters of material? You ought to have used 84,000 liters. How come they use 88,000 liters? Is it due to inefficiency or somebody stealing the raw material? You can see the importance of variance analysis. He's trying to tell you where the problem is coming from. Your variance will be telling you, please monitor this area very well. We are done with material cost variance. You can return to the first page. Go and put the answer there. Here we have 264A, 360A. Adverse variance, that is negative. Positive variance, that is favorable. We now come to direct labor cost variance. You can divide this into 2 also. 1, direct labor rate variance. And you have direct labor efficiency. Let's go and do the working. So please, guys, while you get set for your exam, let's try to look at what we have done. Working 3, labor labor variance. That means formula rates labor rates. They will get the difference. Multiply by actual labor hours. If you go to your standard table, standard labor rate per hour is 120. Standard labor rate per hour is 120 naira. Actual labor rate paid 150 per hour. Multiply by actual labor hours, 21,000 hours. Our plan is to pay 120 naira per hour. We now pay them actual 150. Management will now summon head of HR. Why are you paying them 30 naira extra? This will give you negative variance. 630,000 adverse. Management will now call head of HR. Wait, so how come you are paying these employees 50 naira per hour? Are they special staff or what? Do they have special grade or special skills? Management will ask you. We now go to direct labor efficiency variance. What is the formula? Standard labor hours for actual production minus actual labor hours multiplied by standard rate per hour. Standard labor hours for actual production. Now ask yourself, what is the actual production? Actual production 2,800 units. Management said you should produce one for 10 hours. So if I have produced 2,800, how many hours am I supposed to use? We now pick 2,800 multiplied by 10 hours. Then I'm supposed to use 28,000 hours. My standard hours should have been 28,000 hours. Actual hour use 21,000 hours. You see now? Which means that This set of workers, they are special grade. Maybe this is why the HR is paying them extra 30 naira. They should have used 28 hours to produce. They use 21,000 hours, thereby saving 7 hours. Multiplied by standard labor rate per hour, 120.
$840.
You have 840,000 favorable. At least HR can defend itself that these staff that I've hired, they are actually very, 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 very talented. Here we have adverse. Here we have favorable, 840. Always remember, A denotes negative, F denotes favorable, positive. Next, your variable production overhead variance. You can divide this into two also. We have variable production overhead. Let's shorten this. Overhead expenditure variance. And you have variable production overhead efficiency variance. So please and please, once you master the formula, apply it to question. Working 5, I'm not sure. Variable production overhead variance. I can divide into two. I have variable production overhead expenditure variance. What is the formula? Actual labor hours multiplied by variable overhead absorption rate minus actual variable overhead. We know our actual labor hours, 21,000 hours. Actual labor hours, what? We now need to absorb. Go and check your standard table. Variable overhead absorption rate is at a rate of 60 naira per hour. You multiply these two. That will give you absorbed variable overhead minus actual variable overhead incurred. Check the actual, 660,000. Work this out. You have 600,000 difference. Favorable. Then your variable overhead expenditure. Efficiency. Production. Efficiency variance. Your formula again. Standard hours for actual production minus actual hours multiplied by variable overhead absorption without wasting time. Standard hour for actual production, 28,000. We have computed before. Actual hour use, 21,000. Multiply by variable overhead absorption rate, 60 naira. That's 420. Favorable. Return here. $600 favorable, 420 favorable. The last aspect, we have fixed production overhead variance. Fixed production overhead variance. Under it, you have fixed production overhead expenditure. And we also have fixed production overhead volume variance. So please, guys, I usually tell students, there's no perfect preparation for ICAN. In most cases, You go to the exam as fast as you can read. The nature of this exam, almost everybody is working. You got to work. Some have to deal with family. So don't say, oh, it's natural. But as much as possible, you must prepare for at least, you must be able to go with 10 topics that you know very well. Right? May God favor us. Let's go to the workings. Working 6. Fixed production, overhead, variance. Under it, we can divide it to 2. We have fixed production, overhead, expenditure, variance. This is equal to budgeted fixed overhead minus actual fixed overhead. To get your budgeted fixed overhead, pick your budgeted unit of production. Budgeted unit of production, 2,000 units. Multiply it by standard fixed overhead cost per unit. If you go to that standard, you are going to see 30 naira. That is per hour. Now look at the boss. Now 300 naira. That is the standard fixed overhead cost per unit. Multiply by 300. Minus actual fixed overhead cost, 360,000. 600,000 minus 360. That will give us 240,000. Favorable.
Yes.
Let's put it here. You have gotten the expenditure variance. Our plan is to spend 600,000, budgeted fixed overhead. Actual fixed overhead incurred, 360,000. That means you are saving costs. That's favorable. Then you have fixed production, overhead, volume, variance. Calculated as actual production units, 2,800 budgeted production 2,000, differences 800 units, multiplied by standard fixed cost per unit. This 800 multiplied by standard fixed production overhead per unit, that is 300. 800 units multiplied by 300 naira. That will give you 240 favorable. Our plan is to produce 2,000 units. Within a month, 2,000 units. Our employees achieve 2,800 units within a month. Now return to your fixed put. Here we have 240 favorable, 240 favorable. Now sum. You are done with all the variances. Please take your calculator. For the cost, start from here. Where you have A, this is negative. Negative, 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 positive. Please sum everything. Sum everything. 1, 2, 3, 4, 5. Up to this point. Where you have F, that is positive. What do you have here? You should have 1,290 adverse. If you compute correctly, you should have 1,290.
Up a little bit, sir.
Now check here. Favorable, favorable. Please add these three together. 2,400 plus 288 plus 48. Here you have 3,168. Now, if you are taking it, I'll just do negative 2640. This is negative. Again, negative 360 plus, no, that's negative again, negative 630 plus 840 plus 600 plus 420 plus 240 plus 240. My final answer, negative 1,290. Now, you have 3,168 minus 1,290. Your final answer, 1878. 1878. Actual gross profit. You have used variance to explain how 2,400 becomes 1,878. Look at the actual profits. You're working to. You are done with the question. You are done with the question. Wow. We have like 30 minutes. Let's check again. Let's see if you can. Yes, please. You can ask your question.
Good evening, sir. Sir, this variable overhead expenditure variance. That's what I
This
wanted.
one.
Under your workings, variable expenditure overhead variance.
Yeah, what happened to it?
The one I understand before was in standard rate minus actual rate over times actual hour. And when I did that, it was since it was absorbed with labor hours, so I divided that. So I have 666.
You have what?
I have 606,000.
I'm going to. Are you referring to this?
Yes, this favorable.
And what do you have?
I said what I did was the formula I know before was in standard rate minus actual rate. So since the actual rate was not given, it was absorbed on labor hours. So I divided the 660,000 by 21,000, which it was 31 point. So 60 minus 31.4 times 21,000. So I have 600, but it was 0.6.
Bros, don't do it again. I don't know. Bros, don't do that again. No, I don't have luxury of time to be. Please don't do it again. Maybe you are interpreting wrongly. First, if you want to calculate your absorption rate, you don't use your actual variable overhead. Absorption rate is calculated using budgeted figures. You don't calculate absorption rate with actual figures. Is that clear?
Yes, sir.
So maybe you look at, it's very possible you are interpreting wrongly. But
Okay.
if you have done, maybe go back, or you carefully study what we have discussed and all this formula, regardless of the question, it won't change. For some questions, you need to calculate the absorption rate yourself. If you have to calculate absorption rates at any time, even if you are doing absorption costing, you use your budgeted figures. You don't use the actual figures. So I'm not so sure the time available we take, but at least we can drive the questions more. Still go to your page, I think page 107 now. Look at question illustration 3. IBEC Nigerian, IBEC, yeah, question 3. So let's try this question. As much as we can move with it, let's see. Once it's 11 o'clock, you always, even the student want to go and sleep. We approach May, everybody mind will be in the exam. Look at this. Manufactures a standard and operated a variance accounting using a fixed budget. As a newly appointed management accountant, you are responsible for preparing the monthly operating statement, extracts from the budget for the stand and actual data for the month ending 31st December are given below. Your budgeted and standard cost data, budgeted sales and production, 20,000 units. That means the plan is to produce and sell 20,000 units. Standard cost for each unit, direct material, you have material A and material B. Let's expand this more. That means to produce these products, we require 2 raw materials. For these products, we have 2 raw materials. We have material A. For material A, we require 10 kg. And price per kg is 2 naira. For material B, you require 5 kg. And the price per kg of material B is 10 naira. Standard to produce your direct wages, 5 hours at a rate of 6 naira per hour. Fixed production overhead is absorbed at 200% of direct wages. Now look at it. For this question, there is no variable production overhead. Our fixed production overhead based on budget is absorbed at 200% of direct wage. Budgeted selling price has been calculated to give a margin of 20% of sales. Our budgeted selling price is 20% of the margin. The profit margin is 20% of sales. Now look at the actual data. Actual data for the months, actual production 19,000 units. Sold at a price of 15% higher than the budgeted. Next. Actual material consumed. Material A, 192,000 at the rate of 240. Material B, 96,000 kg at 940, 9.40 kobo. Direct wages incurred, 92,000 hours at 640. Fees, production overhead incurred. Requirement A. You are required to prepare the operating statements for the month ended 31st December. What is operating statement? It's simply a statement that shows profits achieved from your operation. Your operating statement is a statement that shows the profit you achieve from your operation. That is your actual profit. Let's go to this. By the noise of a question, our operating statement for the months ended 31st December 2013. But you need to do small work in here. You must get your actual selling price. So let's do the working. You can raise your hand down, Mishak. That thing is distracting me. Working one. Calculation of budgeted selling price and actual selling price. Let's start with budgeted selling price. Budgeted selling price. You are going to get it from your cost. Look at it. Direct material cost. You have two material. We have material A. Material A. To produce a unit, we require 10 kg. At a price of 2 naira per kg. That will give me 20 naira. For material B, we require 5 kg standard at a price of 10 naira per kg. Five kg standard at a price of 5 naira per kg. Sorry, 10 naira per kg. That means this is 50 naira. Our direct wages to produce 1 unit standard 5 hours at a rate of 6 naira per hour. Five hours at 6 naira per hour. That will give me 30 naira. Examiner says fixed production overhead. 200% of direct wages. Fixed production overhead is absorbed as 200% of direct wages. 200% of 30 naira will give you how much? Or you can do it like this. 5 hours standard, 200% of 6 naira per hour. That will give you 12 naira. 5 multiplied by 12. Examiner says fixed overhead is absorbed at a rate of 200% of direct wages. Direct wages per hour is 6 naira. 200% of 6 naira multiplied by 12 naira. This becomes 6. Your budgeted cost per unit. Budgeted cost per unit. Sum up. This is 16. Examiner now says look at it please. Your budgeted selling price has been calculated to give a margin of 20% of sales price. Margin is calculated on sales price. But I don't know the sales price yet. My budgeted profit per unit, I don't know yet. My budgeted, the profit margin, budgeted profit margin, 20% of sales price. That means I will now get my budgeted sales price. This 20% is supposed to be on sales price. I don't know the selling price now, but I know the cost price. In this case, convert margin to markup. In this case, convert the margin to markup. Margin is on sales. Markup is on cost. Now do like this. Markup is equal to margin over 1 minus margin. If I want to get markup, my markup, the margin is 20%, 0.2, over 1 minus 0.2. That will give you your markup. If you work it out, your markup is 0.25. That is, our markup is 25%. Markup is 25%. Can now come back here now. This is profit markup now. What you are saying is that 25% of your cost represent profit. 25%. Compute 25% of 160, 40 naira. That means your standard profit per unit is 40 naira. Your standard selling price, budgeted sales price, is 200 naira. The examiner says, look at it. Production actual, 19,000. Sold at a price of 15% higher than the budgeted. Our budget is to sell at 200 naira per unit. We now sold at 15% higher than the budgeted. That means your actual selling price. Actual sales price. You pick the budgeted first. Budgeted sales price, 200 naira. Now, plus 15%. 15% of 200. Please compute. What do you have? That should be 30. Your actual selling price, actual sales price, 230. This working is compulsory. Selling price per actual. You can now quickly do your statement. Naira sign, naira sign. Sales value. We sold 19,000 at 230. What is the total sales value? Our students are sleeping.
4,370,000. That is 4,370,000.
4,000,000.
370,000.
370. Let us assume 30 up. Now go to your cost. Your material cost. Actual. You have two types of material. Material A, material B. Come to the actual. We purchased 192,000 kg at a price of 2 naira 40 kobo. Please multiply 192,000 kg at 2.4. Totally
460,800.
460. That will give me 460.8. Assuming 30 up. Go to material B. We purchased 96,000 at a rate of 9 naira 40 kobo. 96,000 kg at 9.40.
902.4.
902.4. Move to your direct wages. Actual. $92,000 hours at a rate of 6.40. $92,000 at 6.40.
$588.8.
588.8. Now go and pick your fixed production overhead actual. 580. Please sum your cost. I have 2532. What is your profit?
1838.
1838. 1838. This is the actual profits at the end of that month. You are done with requirements A. Examiner say calculate all these variants. It's not different from the question. In fact, it's even much simpler. Pick your direct material variances. B. Calculate the following. 1. Direct material variances. Take it into 2. I have A. Direct material price variance. My formula. Now you have 2 material now. You have to do individually. You are going to do for material A. Direct material price variance. Material A. Standard material price minus actual material price. I can't write the formula because of time. I'll come here. Look at material A. Standard material price per kg, 2 naira. Material B, standard material price, 10 naira. I'll now come back here. Actual material 2.4. 5.4. I can take this. For material A, standard material price 2 naira, actual material price 2 naira 40 kobo. Actual quantity of material 92,000 kg. What is the variance here? 0.4 negative multiplied by 192,000. You have 76,800 A. Go to material B. Price variance. Standard material price for B, 10 naira per kg. Actual material price per kg, 9 naira 40 kobo. Actual quantity purchase for material B, 96,000 kg. Point 6 multiplied by 96,000 kg. This is favorable. You have 76 F. Now, one is negative, one is positive. Get your direct material price variance. Add the two together. Combine. Your direct material price variance. I have 57,600. You are going to get 19,200 advance. You now plus the two variances together. So material price variance, negative. They just give me like 15 minutes. Anywhere we get to, we excuse the class. We now come to direct material usage variance. Direct material usage variance. Again, you are going to calculate individual. For material A, standard material for actual production. Our actual production is 19,000 units. And for material A, to produce one, we require 10 kg of material A. So if I have produced 19,000 units, to produce one is at 10 kg. I'm supposed to use 190,000 kg. 19,000 multiplied by 10 kg. Your standard material for actual production, we are supposed to use 190,000 kg of material A. Actual material A use 192,000 kg. Multiplied by standard material price per kg. For material A, the standard price per kg, 2 naira. Work this out. This is like 4,000. Advance. 4,000 naira advance. Material A, we have advance variance. Material B. Material B. To produce one, you require 5 kg standard. That means if I produce 19,000 units actual, I'm supposed to use 95,000 kg. Management said to produce one standard, you require 5 kg of material A. That means if I produce 19,000 actual, I'm supposed to use 95,000 kg of material B. Actual material B used 96,000 kg. Multiplied by standard price. For material B, 10 naira. Work this out. You are going to get 10,000 naira advance. Now add the two together. Direct material usage variance. 4,000 advance, 10,000 advance, totally 14,000 A. So if you want to get your direct material cost variance, direct material cost variance is equal to price variance 19,200A plus usage variance 14,000A. 19,200 plus 14,000. Your direct material cost variance is the addition of material price variance and material usage variance. That will give you 33,200A. You have resolved this. I have like 6 minutes. So you are going to complete it. So we have resolved this. Let's go to labor, direct labor variances. Two. Direct labor variances. We can divide into two. We have A, direct labor rate variance. That is standard labor rate minus actual labor rate. Our standard labor rate, go and check, 6 naira per hour. 6 naira per hour. Actual labor rate, check, 6 naira 40 kobo. Actual labor hours, 92,000 labor hours actual. Multiplied by 92,000 hours. This advance 0.4 multiplied by 92,000. That gave us 36,800 A. Then move to B quickly. Direct labor efficiency variance. Remember the formula? Actual standard labor hours for actual production. Our actual production is 19,000 units. And to produce one, management said use 5 hours. So if I produce 19,000 at 5 hours, my standard labor hours should be 95,000 hours. Actual labor hours, 92,000. Multiply by the standard labor rate per hour. Multiply by 6 naira. This is favorable. 3,000 hours multiplied by 6. Here you have 18,000 naira favorable. Therefore, your direct labor variance, addition of direct labor rates and direct labor efficiency variance. Direct labor rates variance 36,800 A plus 18,000 F. You have negative 18,800. $18,800 A. We have resolved this. Overhead variance, we only have one. That is your fixed overhead variance. Okay, I have to stop here. If you understand what we have been doing so far, you can compute the remaining variance, overhead variance. In this question, we only have fixed overhead, no variable overhead. That means if I come here now, for my overhead variance, number 3, fixed overhead variance. I will divide it into 2. I have a fixed overhead expenditure variance. My budgeted fixed overhead minus actual fixed overhead. To get your budgeted, we plan to produce 200 units, 20,000 units. My budgeted fixed overhead. We are going to produce 20,000 units. And fixed overhead cost per unit, you have calculated Go to your budget. You have computed before. Fees overhead cost per unit. This is 60 naira. Hours multiplied by the rate per hour. 60 naira. 20,000 multiplied by 6. That will give you your budgeted fees overhead. Multiplied by 6. That gave me 20,000 multiplied by 6. 1.2 million. Less actual fees overhead. Actual fixed overhead. Examiner gave us the figure. 580. Let me not even waste time. 580,000. Now look for the difference. Minus 580. 620,000 favoring. Lastly, your fixed overhead volume variance. Fixed overhead volume variance. Actual production, 19,000 units. Budgeted production, 20,000 units. Differences, 1,000 units. Multiplied by fixed overhead cost per unit, standard. Multiply by fixed overhead cost per unit. 60 naira. This will give us negative 60,000 adverse. Therefore, my overhead variance is equal to expenditure plus volume. 620 favorable plus 60,000 adverse. Final answer, 560 favorable. Thank you for your patience. Thank you for your time. Put this answer here. 560,000 F. So please, the last one is your sales variance. Sales variance. What do? Sales price variance. Actual selling price, 230. Standard selling price, 200. Actual quantity sold, 19,000 units. I just try to fulfill all righteousness. That I finish the question. This is favorable. This is says volume variance. Actual quantity sold 19,000 units. Budgeted quantity 20,000 units. Multiplied by the standard profit per unit. Your standard profit is 40 naira. Look at it here. ₦40. That's adverse. That should give me 40,000 naira A. Combine the two. My sales variance. Addition of price variance. 570A plus 40,000. 570F plus 40,000 A. Totaling 530 A. May God give us a better understanding. All right, thank you for your perseverance. Thank you for your patience. Thank you for your cooperation. It's January 6th. Officially, we are closing the class today. If management allow us, we can have additional class, but officially the class is handed down today. I will be checking out. Good night.